Alright guys, welcome back to MMGinvest and WolfPack Cryptos. Let's do a market update in this video. In my next video, which I will upload, will be cryptos. Alright, here's the S&P 500. Alright, so I'll talk about the equity markets, S&P, NASDAQ, and all that. I'll talk about gold, it dumped, and the yield curve. And I'll look at some economic data as well. First of all, this is not financial advice. Consult your financial advisor. I'm not your financial advisor. Equities are extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. And have your stops and emotions out. I'll also talk about my inverse ETFs, my plays that I put on recently in the past few days and last week. Alright, so here's the S&P 500 chart, weekly chart. Every candlestick represents a week. As you can see, the price has rebounded in the past month and a half, almost 2 months now, and it's back above the 23.6 percentile Fibonacci, which is bullish. Now, my heat map is telling me that there's a correction. Now, we did have a slight pullback in the past week and a half now, right? Including this week. This is a weekly chart. Now, if this week, tomorrow, ends like this, it's very neutral. But if we get a sell-off by the end of this week, then it'll start looking bearish. And if next week there's a continuation of a sell-off, then I'm still expecting my correction at least back towards the 100-day moving average, which would take the S&P around 2600, 2700, that area. Now we could also have a slight pullback to 2750, because that'll take us to the 50-day moving average. But looking at the oscillators, look at this RSI. This is very overextended. Let's take a look at the momentum indicator. It was overextended. Now it's nowhere. So it could go either way. It could go back up or down. It could go back up for the short term and then dump. So momentum, we could start losing momentum in the coming weeks. OBV, it's a bit overextended here, and I'm expecting a pullback on the OBV, so that would mean that the price would also pull back. Here's a new form of MACD I'm looking at. I don't like this. Let me pull up just a regular MACD here. So the MACD, I mean, that's neutral, but if it crosses in the coming week, 2 weeks, it could turn bearish, but it's pretty much neutral right now. What's this? My TM squeeze indicator. It's a bit overbought, and it should reset back down to the downside. So I have more bearish indicators than bullish. And in trading, it's probability. So the more ducks you have lined up towards one way than the other, which is leaning bearish right now, then it's more likely. Where's my script? So let me put on the TD. We had a 9 sell. 2 weeks ago. That's why I've been waiting and waiting for weeks now for the stock market to pull back. And it overshot the 9 candle, right? So the candle after that, which was not this week, but the week prior, shot up and ignored the 9 sell, but then pulled back by the end of the week. This week is still trading below the prior week. So far we have 2 candles pulling back from this entire move to the upside. Now, I'm thinking you could count these as a 1, 2, and then 3, 4 candle pullback, right? So that would mean we end this week. Tomorrow's Friday, right? So the weekends. I don't know if a lot of traders will hold over the weekend. I wouldn't, if you're holding on to bullish positions. And they probably won't. So I'm expecting a sell-off tomorrow. And then we'll see how next week opens, Monday. But this is the larger time frame for the weekly. Let's go to a 3-day chart. So there was heavy selling going on for the last 6 days. So this is when you would see an exchange from the smart money to the dumb money. When you have people screaming, "Oh, new all-time highs," and they're buying, but the smart money's selling and the traders are selling. This is a 3-day chart. RSI still overbought, overextended, MACD overextended, and we're about to get a MACD cross to the downside. So 3-day looks like we're going to get a correction, or at least a pullback. Here's the daily chart. We already had a correction if you're looking at the TD indicator. And oscillators are, I would say, neutral right now. Now, there's going to be a lot of support right above 2,700. So we'll see if the 2,700 on the S&P could hold up the price. I like looking at the Russell 2000 as an indicator. See where the S&P and the Dow and the rest of the equity markets are going to go. Now, the Russell's interesting. The MACD looks like it's going to cross to the upside. RSI, momentum indicator, they're like in nowhere land. But I'm not... This is neutral, slight bearish to me. So, on this daily chart of the Russell, if the Russell could break above 1550... then yeah, the markets could rally and then we could start heading to all-time highs. But if the Russell trades around sideways and then breaks below 1500, then that would signal more of a correction, a steeper correction in the S&P 500 and the Dow. That's what I'm thinking. Let's take the Russell to a weekly chart. Looks just like the S&P, right? And it looks like the MACD could cross to the downside in a few weeks. But it could also just keep running higher. RSI is bouncing off of oversold territory. Let's look at a TTM squeeze. TM squeeze is telling me it's a bit overextended. So we have conflicting indicators, right? So I'd say this is very neutral. And the reason I say neutral is because I really don't know if the Fed is buying stocks. Like, I really wouldn't put it past them. I don't trust, I can't trust them. And if they're buying stocks, okay, so someone in the private, well, not the private, the free MMGinvest chat rooms, like, they're going to manipulate gold down, they're going to keep buying stock, or they're going to manipulate the markets up. And yeah, I mean, I know they're probably doing it. I really wouldn't put it past them. Or the plunge protection team, whatever. Here's the thing. If they are buying stocks behind the scenes, it's going to just cause asset inflation. And when you cause asset inflation, which has been going on for the past 10 years since 2009 anyways, but they're directly like buying stocks, are giving the money they print to the banks, and then the banks go buy the stocks, whatever. What's going to happen is it's still going to cause massive inflation. It'll cause inflation in the stock market, but what it's going to do in the long term is just going to cause a bigger crash and a larger wealth transfer to me, who's holding gold and silver stocks. So this is interesting. The moving average crossover here. Why does it look like that? That's weird. Either way, it looks like it's going to cross to the downside eventually here. But that doesn't mean much, because they could cross and then shoot right back up. So I say watch the Russell. Let's take a look at the FANG index here. MACD's crossing over to the downside on the FANG stocks. And this is a daily chart. So there's a bearish indicator. And the TM squeeze looks like it needs to reset to the downside as well. FANGs are below the 200-day moving average as well again. So if this doesn't hold and we don't get a bounce back up to the upside, or breakout really in the S&P 500, which will be up to really these FANG stocks, right? So if these FANGs could break down below 2,600, then we should see a larger correction on the S&P 500. And that's what I'm still betting on and hoping for. Here's the ProShares Ultra Short QQQ. I bought this back down here. This is a 4-hour chart earlier this week, and I'm probably in the morning, we'll see what happens, but I placed a stop. If I get stopped out, I'll take a small profit. And same with the inverse ETF to the Russell 2000. I bought it down here, and I should have taken profits, I guess, up here, but whatever. I'll get stopped out with a small profit. Tesla, I've been shorting Tesla. This is a weekly chart. I've been shorting Tesla for like 3 weeks, 4 weeks, since it broke below the 100-day moving average. And when it broke below the 200-day moving average, I added to my position, but it looks like it's rebounding. So this is another reason why I'm really hoping the S&P and the rest of the market starts falling, because then Tesla's going to get clobbered. And you could almost draw a channel right here. It's too thick. I don't know, not really. You know, if someone would draw a wedge. I hate wedges. Like, look, a wedge. And then what? You could draw wedges anywhere you want. Look, a wedge. I hate these. People who draw these, I don't know. They don't know what they're doing, in my opinion. Alright, so doesn't mean it doesn't sometimes work, but if it doesn't, I don't like the probabilities. I just don't like them. You could also draw a channel, well, a range. So you could say it's range bound here for Tesla. So look at that. So it's been trading in this huge range. Someone's been making a lot of money doing this. Someone pretty much made a full-time job probably trading Tesla. Nice waves. One of these days, it's gonna break down. And that'll be the big short. So right now, some bullish traders are probably hoping it's going to rebound with the stock market. And you could trade it back to the upside. And if Tesla breaks back above 280, like what I just drew right here pretty much. I mean, give it a little bit of leeway, like $5 leeway. Maybe even 10, because it could shoot back up to like 290 and get rejected, or 286 I would say, and then fall down or break this major support. This right here, this line at like 280 is major support on Tesla. So we'll be watching that in the private group of MMGinvest. What's this? All right, so let's talk about gold, and then I'll talk about the yield curve and all that other crap. Gold futures. I'm gonna look at open interest on gold. So, you know, I said it was looking strong. I'm not going to lie. It was looking strong. And I didn't buy into any of the gold ETFs, mining stock ETFs, because I wasn't confident enough that the price was going to continue to keep on rallying. For the short term. For long term, I'm still bullish. This is a weekly chart. Now this yellow is signaling that we're going to get a major sell-off. Let's take a look at the oscillators. Now this is what's concerning, and I said this in previous videos, the MACD crossing to the downside on gold on the weekly time frame. TM squeeze could also go a little bit further to sold territory. OBV, or this is another type of MACD. Where's OBV? Ah, here's OBV. The OBV is also telling me on the weekly here that we might get a sell-off. So we might get a great buying opportunity. Where's the price going to hold up? Well, there's going to be a lot of support looking at the weekly time frame in this area from pretty much 1270 to the very bottom, like 1250, 45, 50, 50. This area is going to act as major support. And we might get a nice bounce and then rebound. Looking at the weekly chart of gold. So let's look at the smaller time frames. Let's look at the 3-day chart. So the blue here on the candlesticks is indicating a possible buy signal. We also have a green Ishimoku ramp right here. And then I don't have a moving average crossover. Where is that? So the RSI is oversold on the 3-day chart. The OBV can still cross to the downside a little bit here. But MACD, it's already crossed over on the 3-day pretty well. So let's see if if the price bounces soon, like tomorrow or next week, that's actually going to look really good because then we have higher lows right here. At the same time, though, I do realize this looks like a head and shoulders. So let's go to the daily chart, see what that's telling us. And this is trend following, guys. This is how you do it. So as of right now, this is still a rising price here as of right now on the daily chart, meaning we have higher lows, and that's bullish. Of course, if the price does break below its current price, especially once it breaks below like 1285, 1280, then the head and shoulders comes into play. So that looks okay. So the neckline is a little bit higher. Let's draw it a little differently here. So head and shoulders, they don't matter until they are fully formed. And when you get a head and shoulders, it doesn't mean that it's always going to drop. Same with inverse head and shoulders. We saw that a lot with Bitcoin. It would get an inverse head and shoulders and the price would dump anyways. So, you know, these patterns, they give you nice probabilities, but they're not always going to play out as people think. But yeah, so the price does not have to drop much more to complete the head and shoulders. And if it does, then yeah, the price will, then I'm thinking we'll get more of a pullback and correction here. But, you know, on the daily here, we have support at 1280. We have support, and then the price, even if it does fall past 1280, it's going to start falling into that major support area from the weekly time frame, from the larger time frame. And, you know, I'm going to start dollar cost averaging in this entire time. So, you know, if it falls lower, great. I'm going to start dollar cost averaging in to my not leveraged ETFs that you trade, just the stocks that aren't leveraged. You know, they could fall another 20%, and as long as you don't sell, it doesn't matter, right? You're just holding for the long term. That's if you're a long-term holder. If you're trading, then you're a trader. Then you see, I do both. So I'm going to wait and see how far this pulls back, and then I'll see if I'll buy some leveraged ETFs like JNUG or whatever. But those are extremely risky to trade, especially if you're not experienced. Like, you'll get a margin call. You'll get slaughtered. So, gold. I don't care, guys. Gold is an insurance policy, and it's also a long-term trade. I don't care if gold falls another 6 months. I'm actually happy if it does. If it falls another year, I'm even happier. I'll just keep loading up. But eventually, reality will hit. And if the stock market hits all-time highs and keeps going higher and higher and higher, then, well, gold's going to keep going higher because at that point the Fed is printing money to pump the markets higher and we have asset inflation. So you can see gold go higher and the stock market and the dollar go higher all at once for the short term. And then for the long term, why isn't this working? But for the long term, gold's going up. Here's the S&P again. Just a reminder, I was looking at this, and on the weekly, I still think this could easily sell off, and it should. If it keeps rallying and rallying, then it's going to have an even bigger correction when it does get that correction. So it's actually in the best interest of the stock market to get the correction sooner rather than later. Because if this keeps just going higher and higher past all-time highs, then we're going to get a real big correction, larger than this one, in my opinion. And then the Fed's going to come out and print money, and then who knows? We'll look like Venezuela's stock market. So, you know, if it pulls back and then bounces higher, the Fed's probably not going to freak out. If we get a deep correction, the Fed's going to freak out here, and they're going to start lowering rates. Then the price is going to go up, and then they're going to come out with QE, and then off to the races, stock market, Venezuela style. S&P is going to go to like 5,000. And that entire time, gold's going to rally for me. And I'm still trading, right, stocks. But right now, I'm not bullish because I'm afraid this is going to turn into a giant bull trap. Still. Excuse me. Let's look at the yield curve. Or let's look at some fundamentals. Alright, so U.S. household debt to GDP. It's not at 2009 levels. But, back in 2009, people were taking on debt because they thought the economy was just going to keep getting better and better for decades. Like, no one ever saw a huge recession coming. So people were maxing out credit cards. People were buying homes and cars that they really couldn't afford. They were leveraging up, and they thought the good times were going to roll forever. So that's why household debt was higher than it is right now versus GDP. It's still historically really high. It's just that a lot of people went bankrupt, or, they had to file Chapter 711, and they can't get credit cards like they used to, like back prior to 2009. So the household debt to GDP is actually smaller than it was. That's my theory. Can I be wrong? Yeah. Here's household debt service payments as a percentage of disposable personal income. Now, this is the most bullish chart that people look at and they point at and they say the economy is going to be booming for like the next 5 to 10 years. So household debt as like payments, like monthly payments, versus the percentage of disposable income for per household, meaning supposedly people have more disposable income every month right now versus the amount of debt they need to pay monthly. And I think that is because of the baby boomers. They stopped racking up their debt payments and taking on loans, unnecessary loans, especially after 2009. And, a lot of the kids have left the house now. They've already gone to college and whatnot. So that might skew the numbers. Another thing that you could consider is, a lot of people did learn their lesson, and they're not racking up credit card debt like they used to. And a lot of people probably can't get as much credit as they used to because their credit has fallen and went to crap since 2009. But that doesn't mean that people aren't drowning in debt. It just means they're not taking on like credit card debt and more risky debt for buying things like luxurious things or buying cars. And a lot of people have taken on subprime loans for cars. It's not calculated into this. This is just pretty much credit card debt. So debt to income ratio. Now, adjusted for inflation, income really hasn't gone up for decades for U.S. citizens, and it's pretty much true for Europe and Australia, China. I don't know. I'm not sure about Asia, but it's still historically high. It's around 90 percentile, right around 2008, right before 2008. It was around 115%. So it's still historically extremely high. And it looks like it's starting to creep. Well, it had a nice pullback correction since 2008. And now it's going to start going up higher again. And I think it's going to do that debt to income ratio, because what's going to end up happening is people are going to have to take on more and more debt just to make ends meet. Like when your car breaks down, you can't pay for it. People are going to take on more debt to pay for it. Because inflation's going to kill the middle class. So as the dollar gets sacrificed to keep the stock market from imploding and going higher through asset inflation, what's going to happen is your disposable income, or your income is going to not be able to pay for food and everything, because inflation is going to start creeping higher. And as inflation creeps higher, people are going to take on more debt just to, when emergencies happen, or to pay for things when something breaks in the house, or you name it, healthcare. Also, nobody thinks about this, but if inflation really starts getting out of control, your income actually, companies might actually start raising people's income because people will stop going to work because it'll be too expensive. It won't be worth it. And especially with gas prices going up. So the stock market might be going up, oil might be going up, but the dollar is going to be falling. Or the dollar versus other currencies may not be falling, just going sideways, but the dollar versus food and real things in the world will be falling in value. And people might actually start getting raises, and that's going to skew the economic data. But what you're going to end up getting is income tax creep, meaning you might get some raises and you're making more fiat paper, dollars, but the paper and the dollars are worth less, but now you're going to start ending up being in higher tax brackets. And then you're going to pay more taxes. And that's like another way how the hidden tax of inflation destroys the middle class. So Americans are doing good servicing their debt right now, but that could change real quick. But that is the number one indicator that's saying things are okay. Now, households are taking on more debt overall. And this isn't versus GDP. This is versus this is just debt historically. So far, lack of huge uplift in household debt in the U.S. has been one positive in the current business cycle until that is. One looks at the underlying figures and relative comparative. Here is the chart from the fact set on the topic. I'll post all these articles in the comment section below. But, overall debt is rising. It's pulled back since 2009, but it's still historically high. So aggregated household debt, this is pretty much the same chart. Here's another chart. What's the source? This is the Fed. Yeah, this is the Federal Reserve source. And they skew these numbers again, so because GDP isn't calculated properly, so it skews everything. Everything's worse than it really looks. I mean, we're below the pre-crisis long-run average, but we're not that far off. So So United States private debt, so people, the retail shopper, who right now can't go to Payless anymore because Payless Shoes just went bankrupt. That was a huge chain. And that's, everyone's blaming it on Amazon. How many people buy shoes off of Amazon? Listen, I don't think people are shopping as much as they used to. And yeah, Amazon does play a role in the brick and mortar retailers from going under, but honestly, I think the consumer is just weak. They're not shopping as much as they used to for clothes and stuff like that. So here's historical data, 2009, and we're creeping back up. So private debt versus GDP. And like I said earlier, the GDP numbers are not as great as the Fed says they are if you actually adjust them for real inflation. So technically, this is probably higher than it was in 2008 and 9. But I could be wrong. Just saying. But looking at this, I mean, it's going to creep higher because US GDP, it's been revised and it just fell lower. So I just put out economic data in the chat groups. Where is it? GDP fourth quarter of 2018. Actual was 2.2%. Previous was 2.6%. Consensus was 2.4%, so it was lower than what people even thought. And towards the end of 2018, people were super bullish. They thought, this economy can't stop. Consumer spending's falling. Corporate profits are at 0%. They were previously 3.5%. Let's see what else I have. 8-week bill auction. Here's bonds. The 8-week is higher. Well, it's the same as the 4-week. And the 7-year is lower than the 4-week and the 8-week bill auction. So here's household debt service payments. Yeah, I already showed you guys this. Here's corporate debt to GDP. It surpassed 2008 and 2009 levels. And the economy was much stronger in 2006, 7, and 5, and 8 than it is right now, in my opinion. And a lot of you think back towards the early 2000s. Didn't it seem like the economy was stronger? Yeah, it did, because it was. And the dollar was also stronger back then. Remember the 90s? That was even stronger than the early 2000s. That was booming times compared to the early 2000s. And I think the 90s was peak prosperity compared to today. But these corporations are taking on historic levels of debt. On top of that, they're buying their own stock with the debt. So if the market falls, seriously, these Fortune 500 companies can go bust. That's another reason why, the Fed's going to fully capitulate and bring out QE so these corporations and banks don't go under, because if they do, I don't know, it's going to be really, really painful, like worse than the 1930s Great Depression probably. I don't know. I'm just a guy. Could be wrong. Equifax. So the credit agencies, right? They take your social security number, which wasn't supposed to be used as identification and wasn't supposed to be used for credit for your so I don't want to get into it. But Equifax and FICO partner to sell consumer data to banks. That's pretty messed up. So the banks can find out who has good credit, so they could send them in the mail and email them all kinds of crazy offers, so people go further into debt, because no one's taking on debt, because honestly I think most people are just they're living paycheck to paycheck, and most people know if they take on debt, they're not going to be able to pay it off, but they will probably eventually start taking on debt just to pay off, just to pay for monthly expenses so they can live. Because inflation's, like I said, is going to make groceries cost more. And I honestly, personally, from the things I usually buy, I see it happening already. Like I buy energy drinks like every other day, and those have gone up in price, at least 15%, something like that. What else? Everything's gone up in price for me. Like from the daily things that I buy. And people are going to cut back, you know, as prices keep going higher. This was a pretty good podcast. I posted this in the chat rooms. So let's take a look at the yield curve. What's this? We'll look at the gold open interest, the short positions. So the yield curve, I mean, I've shown this a bunch of times. This yellow line, I pushed it back to like the peak where the yield curve was inverted. This is what it looked like, okay? So here's current time. Let's run this through the current time. See, that's normal for a low interest environment. And then here's the business cycle flipping because of the Fed. And here's where it is. Is that where it is today? Yeah. So the 30-year and the 20-year steepened. And the yield curve's getting pushed back down, and it's not as inverted. But here's the thing. It's rising. So the entire yield and the interest on it is rising overall. See how low the 7-year is and the 10-year? It's below 3%. And the 5-year is below 2%. Where is it today overall? It's above 3%. The 5-year. The 7-year is above 3%. 10-year is above 3%. 30 years staying put around 3%. So overall, it's rising. What happened in 2008 and 7? How did it look like? This is what it looked like. Wait, what year is this? Let me make sure. Oh, this is 1999. Hold on. So before the yield curve inverted, so this was, where were we? This is 2005. All right, here's 2006. You can see how high it is. It's the yield was up in the 4 percentiles. All of them were. But, you know, before that, in 2002, it looked like this, right? But you see how the entire curve, well, not even curve, all the interest, all the yield on all the bonds, it rises overall and goes higher and higher. And that's the bond market signaling that that the stock market's going to correct because people are looking for safety, so they're buying bonds. That's why we get a yield curve inversion. And the traders, the speculators end up buying shorter term bonds, pushing the yield higher because they're looking for safety. Oh crap, is this? No. Why is this? Keeps going back to 1969. Alright, this is where we are today. So I'm expecting all of the yield on all of these years, from the 10-year all the way to short term 1 month, to keep rising a little higher and then invert. But I expect the 30-year to keep going higher and higher. and it won't fully invert. It might just kind of look funky like it did a few days ago. All right, gold. Let's look at the COMEX open interest. So people don't understand open interest. Open interest is like it's the speculators. How interested are they? Pretty much in the asset class. So if open interest is rising and the price is rising and volume is rising, that's very bullish. If price is dropping, volume's dropping, and open interest is dropping, that's very bearish. And then there's different, variations of all that. So what I want to see is the volume on gold rising, and is the open interest rising? Because if open interest and the volume is rising, then that means there's a lot more interest in gold. Interest in shorting, interest in buying and going long, right? So here's gold, here's the open interest. And every time you see the longs converge with the shorts, you get a nice price spike or a dump. So here, a good example is it converged right here. And then we had a nice rally in 2016. And then the longs and the shorts converged again. And they duked it out, they battled it out, and then we had another rise. And then the same thing happened again just recently, a few weeks ago, and we had a nice recovery in the price of gold in the past 2 months, right? So now they're gonna come together again in the coming weeks, and we could expect the price to possibly pull back for a few more weeks, and then they're gonna converge, and then either the price is gonna dump or it's gonna break up to the upside. I think it's going to break up to the upside because honestly it's consolidating. It's just consolidating. If we look at a gold chart, so here's the gold again, weekly. Hold on. Zoom out. You can see it right here. Look at this. There's definitely more volume coming into the market. It's picking up. Look at this slope. So there's more interest in gold. Look at this. It's actually, if you look at it from a long-term perspective, it's rising. It's just the amount of volume being traded is rising. So you could say there is manipulation to the downside. They keep shorting it, but it takes more and more money to keep it down. I had some stats. Where's the stats? First of all, let's go to a 5-year. Let's take a closer look on the open interest for gold. This would load. I think I just closed it. Alright, great. Yeah, the stats aren't here. Well, I'll cover this next time. Yeah, we see consolidation right here. So there's more consolidation in recent months and year. Let's take a look at the 1 year. So it's gonna consolidate again the next few weeks and months. And then we'll see if we could get another breakout in gold past like 13, past the previous high around 1350, then I am very convinced and confident that we're going into a multi-year bull market in gold. And I already know we are, because the Fed has already capitulated. Remember, they've already stopped raising interest rates because they can't raise them any higher, because if they do, they'll pop their own bubble. All right, guys. So that's pretty much it for now on the economy. Put in the comment section below what you guys want me to cover, so I have good ideas. I think I'm gonna make some more tutorial videos, like 10-minute videos, and then how to trade. I'm also gonna make, like, maybe I'm gonna make some self-help videos, like little 5-minute videos, 10-minute videos, to grow my channel, to get more people, because people are just, they're sheep. They're not paying attention to the economy and the markets. They're only paying attention to politics, but they're not paying attention to what they should be paying attention, which is the economy. I feel like politics, Trump, and all this crap that's going on these days, it's just a symptom of the economy, and it's there's no point of really paying attention too much to it, because in the end, it's not gonna matter. The only thing that's gonna matter is the economy. Alright, guys, smash that like, share my videos. I would really appreciate it. And leave anything in the comment section. It helps out my videos, rise in the search algorithm for YouTube. Until next time, guys.